These ideas don't just exist in textbooks, they govern our day-to-day realities. Whether you're out shopping, investing, or even deciding not to spend, these principles are at work, shaping your choices and your future. Let's start with scarcity, the most fundamental idea in economics. Scarcity is about one simple truth: resources are limited, but our desires are infinite. Think about it, whether it's time, money, or even the number of iPhones on the shelf, there's a limit. And the fact that we can't have everything we want forces us to make choices. It's why you can't buy every gadget you see, or why you have to choose between saving for a house or going on that dream vacation. Scarcity is like the ultimate referee in the economy, constantly pushing us to prioritize.
Click subscribe to this channel to get more topics you love.
But here's what makes scarcity so powerful: it's not just about money or physical goods. It applies to everything. Your time is scarce, your energy is scarce, even attention is a scarce resource. And because of this, scarcity forces you to think about opportunity cost, what we give up when we make one choice over another. I want you to think about this for a second. What's the last thing you had to sacrifice because of scarcity? Maybe it was sleep because you had to work late. Or maybe it was money because you decided to buy something instead of saving. Every choice has a cost, and it's not always obvious. Scarcity forces us to confront these trade-offs, whether we like it or not. Now, here's where scarcity really messes with our heads. It creates value. The rarer something is, the more valuable it becomes. That's why diamonds cost more than water, even though water is essential for life. It's all about perception. But here's a key piece of wisdom. Scarcity can also be manipulated. Companies often create artificial scarcity. Think limited edition sneakers or holiday toys. They make you feel like you have to act fast or you'll miss out. But the truth is, it's a psychological trick to drive up demand. So next time you're tempted to splurge on something rare, ask yourself, is this scarcity real, or am I just being played? So we've got scarcity. That's the starting point. But now, let's talk about supply and demand, the engine that drives prices. If scarcity is the reason we have to make choices, then supply and demand are the forces that determine what those choices cost. It's a simple concept, but has profound implications. Here's how it works. When something is in high demand, but in short supply, the price goes up. And when there's more supply than demand, prices fall. But here's where it gets interesting: market equilibrium. This is where supply and demand meet in perfect balance. It's the price point where everyone who wants to buy can buy, and everyone who wants to sell can sell. It's like a sweet spot. But here's the catch: equilibrium is constantly shifting. New technology can increase supply, driving prices down. A sudden trend can spike demand, pushing prices up. And you, as a consumer, are caught in the middle of this dance, trying to figure out when to strike. So let me ask you this: when was the last time you bought something and then the price changed right after? Maybe you bought a new phone, and a month later, there was a sale or a newer model. Supply and demand are always in flux, and understanding this can help you make smarter financial decisions. All right, we've covered scarcity and supply and demand, but now we get to something even more personal: opportunity cost. This is the concept that every choice you make has a cost, and not just in dollars. It's the cost of the next best alternative you didn't choose. Every time you decide to spend money on one thing, you're giving up the chance to spend it on something else. Every hour you spend binge watching Netflix is an hour you could have spent learning a new skill. Opportunity cost is everywhere, and yet it's often ignored because the cost you don't see is hidden. Let's say you decide to invest $1,000 in a stock. The opportunity cost isn't just the risk of losing money. It's also the potential gains you could have made by investing that money elsewhere. Or maybe you're deciding between two job offers. The opportunity cost of choosing one isn't just the salary you're giving up, it's the work-life balance, the career growth, the relationships you'll build or miss out on. Here's a deep question for you. How often do you consciously think about what you're giving up when you make a decision? Most of us don't. We get so focused on what we're gaining that we forget about the hidden costs of what we're losing. But understanding opportunity costs can change your entire decision-making process. It forces you to think about the long-term consequences of your choices, not just the immediate gratification. And this brings us to a crucial point. Opportunity cost isn't always about money. It's about time, energy, and even emotional investment. Every relationship, every job, every purchase has an opportunity cost. And the more aware you are of it, the better decisions you'll make. So next time you're faced with a choice, ask yourself, what am I really giving up here? Sometimes, the best decision is the one that maximizes long-term benefits, even if it means sacrificing short-term satisfaction. All right, we've talked about scarcity, supply and demand, and opportunity cost. But now we get into something even more subtle but just as powerful: incentives. This is the hidden force that drives behavior sometimes without you even realizing it. We like to think we're in control of our decisions, but the truth is, incentives shape almost everything we do. They're like invisible strings pulling us in one direction or another. Incentives are everywhere, shaping the choices we make, often without us even knowing it. Think of them as the invisible forces, the carrots and sticks that drive our behavior. Whether it's a reward for good behavior or a punishment for bad, incentives push us towards certain decisions. But here's the thing, we're all susceptible to them, even when they're subtle. Let's say you're offered a discount for buying something in bulk. That's an incentive. Or maybe your job offers bonuses for hitting a sales target. That's another incentive. These nudges influence how we behave in both small and large ways. But not all incentives are financial. Some are intrinsic, meaning they come from within. You might work hard at a job not just for the paycheck, but because it gives you a sense of accomplishment. What's fascinating is how misaligned incentives can backfire. Take a company that offers bonuses for short-term profits. Sure, executives might work hard to boost earnings quickly, but they could be sacrificing the long-term health of the company. The key is understanding which incentives are guiding your decisions and whether they align with your long-term goals. Ask yourself, what drives my decisions, external rewards or internal satisfaction? If you're always chasing the next reward, you might be missing out on deeper fulfillment. The most powerful incentives are those that align with your values, not just your wallet. Now, let's talk about how incentives shape supply and demand. When prices rise, producers are incentivized to create more. And when prices fall, consumers are incentivized to buy more. It's a constant push and pull, and it's all driven by incentives. But here's a tip: be mindful of the incentives that drive your spending. You buying something because you need it or because a clever incentive made it hard to resist. Finally, we come to trade and markets, the global stage where all these economic forces come to life. Trade is about exchanging goods and services, and markets are where these exchanges happen. But it's not just about money changing hands. Trade allows us to specialize, to focus on what we're good at, and then exchange that value with others. It's the reason why you don't have to grow your own food or build your own phone. Instead, you trade your skills or money for what others have specialized in. Markets are more than just places where we buy and sell. They're systems that reflect our collective choices. They determine prices, allocate resources, and even drive innovation. When a product is in demand, the market responds. When something isn't selling, producers adjust. It's a delicate balance, and yet it's incredibly powerful. By understanding these core economic principles: scarcity, supply and demand, opportunity cost, incentives, and trade, you gain the power to make smarter decisions. You'll see how your choices connect to the bigger picture and how the forces that control your wallet are the same ones shaping the world around you.